about to proceed to the final presentations. These are the 5 finalists. I just want to just to remind all the faculty sponsors that you're only allowed to see the teams after your team has presented. You're obviously allowed to see your own team, but if your team have not presented yet, we ask you to wait outside before your team presents in order of fairness. Okay, so we have 5 teams, 15 minutes presentation and 20 minutes of Q&A. And there's a prominent digital clock there. It looks like one of those ones on the shows, that shows explosions coming on. But 15 minutes for presentation, 20 minutes Q&A. And the first team presenting will be Midas Capital. It's Midas Capital.
The US real estate industry is currently undergoing a rapid change as we're moving away from inflated asset prices in primary markets towards rapidly growing secondary markets. The investment opportunity presented to Viking today will take full advantage of this emerging trend. Good afternoon, my name is Ronnie and this is Isabel, Roy, Brett and Alan, and we are Midas Capital. Today we recommend that Viking acquire the asset at a significant discount to market price in order to take advantage of FTS's precarious financial position. As such, we have 5 key messages for your board today. Firstly, the US Bancorp Center is a high-quality asset that is situated in a fast-growing secondary market. Secondly, by capitalizing on its uncertain lease terms, we believe that Viking can acquire the asset at a significant discount to market value. Thirdly, by exchanging tenant exclusion rights, we believe that Viking can secure early re-sign and renewal from US Bancorp, even if it is at a lower occupancy rate. Fourthly, in the event of this decline in occupancy, we recommend our R-cube strategy in order to maximize the value of the asset. This would involve renegotiating the rent with US Bancorp, renovating the vacant space to appeal to tech clients, and finally revitalizing the upper floors of the building in order to introduce a complementary co-working space. Finally, our analysis indicates that 2022 is the ideal exit year in order to capitalize on peak occupancy and weighted average lease expiry. Now, before I go into the details of our analysis, I want to start with a quick investment summary. So our analysis has valued the property at $167 million. Now, although we believe you can negotiate a $10 million discount and thus enter at $157 million, we're going to use $167 million as our base case analysis in order to provide a conservative estimate of returns. This $167 million acquisition entry price means that Viking will require a $7.6 million initial equity contribution. However, upon exit, we believe you can exit the property at a 6 cap rate, thus achieving exit value of $318 million and a project IRR of 20.8% and a 3 times money multiple. However, this is just one case scenario. We've also considered all the different leasing situations that US Bancorp could introduce. And in the worst case scenario, where US Bancorp vacates the whole building, our analysis indicates that you will still be able to achieve a 15.4% IRR and 2.6 times money multiple on the investment. As such, this investment presents a unique opportunity where the returns in the worst case scenario are still acceptable, but has huge upside potential. Now, moving on to some contextual analysis, our analysis indicates that Minneapolis is a fast-growing secondary market with low unemployment, decreasing vacancy rates, and upward pressure on rental prices. In other words, it's a market prime for investment. However, the particular asset in question has very prohibitive leasing terms. With variable renewal, uncompetitive rent, and a 35% participation, this asset has a significantly high risk profile, and these variable leasing situations add complexity both the valuation and the business strategy. However, Viking specializes in adding value in imperfect markets. And as such, we believe it's still a good investment for your company. I'll now be passing on to Roy, who will be discussing our acquisition strategy.
Thanks, Ronnie. So how do we go about acquiring such a high-quality asset with such prohibitive leasing terms? Midas Capital identified 3 key issues at hand. 1, how much do you pay? 2, how do you secure an equity capital partner? And 3, to what extent are you going to be catching a falling knife? Beginning with the first issue of how much do you pay? Our analysis shows that despite the asset is of high quality, despite the asset of being of high quality, our analysis shows that the variability and the variability of the cash flows will depress the valuation price, which we have triangulated at a price of $167 million. However, given FTF's precarious financial position and the notion that with each successive year that USB doesn't renew its tenancy agreement, the potential sale price will fall, thus justifying our initial offer price of $157 million. Despite this being of a smaller suppressed price compared to the initial offer price, our analysis shows this is justifiable, given that FTF's IRR under this price would still exceed charitable benchmarks, making them well over 10% per year. Issue 2 primarily surrounds how you would secure an equity capital partner, given that many investment funds would shy away from investing in real estate assets that have an imminent leasing expiry. Furthermore, our equity partner must be willing to accept our absolute worst case scenario, which is 100% vacancy of USB, causing an imminent cash sweep to be triggered. Furthermore, our equity capital partner must be able to have a fast turnaround. Thus, this precludes a number of various equity capital partners based on risk appetite and speed of execution. Thus, we believe that private equity is the only viable option here. However, private equity comes at a cost, and so how exactly do we secure a private equity? We justify securing our private equity partner based on justified on returns, given that even in our absolute worst case scenario, they're still able to generate a 15.4% IRR, which matches most PE benchmarks. Furthermore, as a further incentive, we're able to provide a favourable promote structure as well. Midas Capital has identified Square Mile Capital as being a suitable equity partner, given that they have had experience with JV ventures within Minneapolis already, and furthermore that they offered to provide debt financing to you, and as such will already be interested within the asset and have a deep knowledge and understanding of the asset. Partly, how do you protect yourselves from several key issues? FTF could negotiate with other buyers, and furthermore, your PE partner, there could be issues with regards to strategic control of the asset with your PE partner. And finally, there is some reputational risk for Viking. As such, we propose a solution to these three aforementioned issues, which is to purchase a no-shop, no-talk contract, which prohibits FTF from approaching other buyers and also from releasing public information about the deal. Additionally, we recommend that you purchase media release control as well. And now, Midas Capital believes that these rights can be acquired for a nominal fee given Viking's leverage over FTF at the moment and their precarious position. In summary, we recommend that you first obtain the aforementioned options from FTF, next secure an equity capital partner, namely Square Mile, and finally submit an initial offer price for $157 million, but be willing to negotiate up to $167 million. I'll now pass you on to Brett, who will walk you through the business strategy.
Thanks, Roy. So let's talk about how we can maximize the value of your investment. To determine the most optimal business strategy, we have devised a framework that considers three factors. Firstly, how US Bancorp will react to our negotiations. Secondly, the macroeconomic drivers of growth. And finally, characteristics of the building we're looking to buy. Our analysis of US Bancorp is on three dimensions. Firstly, lease renewal. Secondly, the lease duration. And finally, the floor space they will take up. As a large public company that already occupies an immaculate building and with very little supply in the Minneapolis area, USB isn't going anywhere. With medium-term leases that offer the best compromise between costly rent increases and business flexibility, we believe that they are most likely to renew for 10 years. Finally, despite space optimization trends decreasing the amount of floor space per employee, we believe that 755,000 square feet is the minimum floor space required to provide adequate space for USB's employees. Although our strategy considers this scenario, we have strategies and analysis for every single possible leasing scenario. However, why did we pick this one? So Midas Capital believes that Viking will not only be able to negotiate a 15-year lease renewal as opposed to a 10-year, but also do this earlier in 2016 as opposed to 2018, which significantly decreases the risk of our investment. US Bancorp strongly values tenancy control rights to the extent that they are willing to pay for space that they don't need in order to keep their competitors out. As such, we believe that negotiations using tenancy exclusion rights as leverage will allow us to secure a successful lease term. In terms of deciding what the best use of the remaining space is, we looked at macroeconomic growth drivers, finding that the tech sector in Minnesota is experiencing significant growth. Additionally, an increase in VC funding that now meets the demand in the area has reversed negative co-working and startup trends, and both of these now present amazing opportunities that we can capitalize on. With this in mind, Midas Capital would like to present to you the R-cubed strategy: renegotiate, renovate, and revitalize. The renegotiate component of our strategy involves renegotiating our rent with US Bancorp, providing a $10 per square foot tenant improvement allowance in exchange for a $2 per square foot rent increase from 2020 onwards. This will not only assist US Bancorp in downsizing from 100% to 84%, but also improve their collaborative and recreational facilities, which furthers their agenda of attracting more millennials. For a total cost of $7.8 million, you'll be able to increase your net operating income by $1.8 million and improve your IRR by 2.3%. The renovate component of our strategy divides floors 25 to 28 from the 25,000 square foot floor plate into smaller suites. Midas Capital has identified significant demand for sub 10,000 square foot Class A office space due to the tech boom in the area. As such, a $4.7 million cost, which includes subdivision costs, leasing commissions, and renovations, increases your NOI by $1.5 million and your IRR by 2.2%. Finally, the revitalized component of our strategy transforms the top 3 floors into an innovative co-working lab. Now, with a total equity cost of, again, $4.7 million, you increase your NOI by $3.1 million and your IRR by 3.5%. This space also features vertically interconnected stairwells, which not only decreases vacancy risk by reducing the amount of space that each tenant occupies, but also promotes collaboration without the need for excessive lifts. I'd now like to pass on to Isabel, who will discuss our further financing considerations.
Thanks, Brett. Now, regarding our debt financing situations, we believe that option 4 is the most viable option, which is vendor financing, due to execution speed, flexibility, and debt covenants. Also, option 4 generates a 20.8% IRR, and it is the only one that is attainable in a short period of time. Also, it has no prepayment penalty. Thus, if market conditions change, we are still able to exit early or alternatively refinance the loan. As you can see, option 3 generates a higher IRR. However, it is too risky, since if the debt recourse is triggered, it would threaten our equity capital partners' assets. Thus, through the option 4, we believe that we are able to get a $10 million discount on our acquisition price, and this will increase our IRR by a further 4.8%. Alternatively, we believe that option 4's LTV can be negotiated, and we believe there is room for renegotiation because our cash flows significantly exceed our debt covenants. Therefore, we believe that through renegotiating a 10% increase in LTV, we will be able to increase our IRR by a further 4.1%. Thank you. I'd now like to pass on to Al.
Thank you, Isabel. So now the question becomes, what sort of returns can you make from this investment? Well, if you aim to capitalize on the peak weighted lease expiry in an exit in FY22, our analysis has shown that you can obtain an IRR of 21.4%. And this is before fees, and it equates to 20.8% and a 3 times cash multiple after fees. Now, each and every element of our R-cube strategy is our NOI accretive and results in an overall 8% boost to our IRRs. Now, the returns we've achieved have been able to hit the hurdle rate of 15% we negotiate with our equity partner, and as a result, allows us to partake in part of the profits thereafter. This results in a $7.8 million equity bonus and results in an increase in IRR to 26.9%, along with a 3.7 times cash multiple. Now, in terms of exiting, the risk of this asset and also the lack of demand has currently provided us an interesting opportunity to be able to enter. However, this may create tensions in the future about finding potential buyers. Our strategy effectively de-risks the asset, resulting in higher occupancy rates, a longer weighted lease expiry, and also stabilised cash flows. As a result of this, we're able to open the pool of potential buyers to real estate investment trusts, along with insurance funds, who would find the stabilised cash flows of this transformed asset very attractive. As with all strategies, risks are to follow, and we've identified execution, financing risks, market risks, and political risks, which we have addressed through individual mitigation strategies. But to sum up for you today, I'd like to rehash the fundamentals of this investment opportunity. Midas believes that you can capitalise on a superb investment opportunity by entering at up to $167 million with an implied cap rate of 8.4%. Now, exiting at a price of $318 million, you can achieve a return of 20.8% and a cash multiple of 3 times. Thank you for your attention. We now open the board to any questions.
That was great, thank you. Quick question, I may have missed it, but did you talk at all about the tenant profit participation? How was it calculated? How did it go into your economic analysis?
Yeah, so...
And then also, just to follow up, is just given where the tenant is, why do you think they would renegotiate the lease early?
Okay, so firstly with the equity, the waterfall structure for the approach analysis, you go back to the, what slide is it?
No, participation.
Oh, participation. So, the DCF, sorry. Now if we go to our DCF, which is on
Slide 61.
slide 61, or actually no, the better one will be slide 60, go to 73. Yeah, 65. Go back to the analysis. Sorry, I was trying to get the right. You want the cash flows, so you'd be looking at 67. Yeah, so we have factored in the participation. So because we're exiting in 2022, that's after the 2020 deadline participation, and hence to factor this in, we have this negative cash flow in 2020. That's based on a 6.2% cap rate in 2020, which actually is a very favorable estimate for USB. That means we could actually reduce that cash flow potentially, and therefore increase your IRR. What's the second part of your question? Sorry.
Just timing of when they would renegotiate the lease.
Oh, the renegotiate lease. So as we mentioned in our main presentation, we believe we can secure early renewal based on the fact that we're going to offer them tenant exclusion rights. So US Bancorp has made it very clear that security in their building is very, very paramount to them, and they're currently willing to pay for vacant space just to ensure that it's not actually occupied by someone else. Hence, if we can offer that to them, and that was something that the previous owner refused to give them, we believe we can trigger them to renegotiate early.
You talked about your downside, I guess, being 15.4%.
Yeah.
What are your assumptions there, and how do you reposition and tenant and what?
Yeah, so in that scenario, we forecast a 100% vacancy in 2020. But even in that scenario, we do have, they do tell us in 2018. So we have from that point onwards to engage in a leasing strategy. So we've assumed, a very generic, a 4 or 5 year leasing strategy in order to we have a 900,000 square foot asset.
So your whole period changes in the...
Yes. So
yes, our whole period changes.
in that case, the whole period is now 2023 to adjust for the fact it's going to take us longer to lease up. In terms of leasing partners, we were planning to target multiple new sort of miniature anchor tenants. So particularly focusing on medium-scale tech companies. So there's a slide on this as well. If you, in our base case scenario, we're looking at smaller tech companies. However, we've also identified a number of medium-term tech companies who could come in as this medium tenants in this scenario.
Yeah, so just to carry on from what Ronnie was saying there, some of the ones that we identified were up-and-coming tech companies within Minneapolis, such as the Nerdery or Sports NGIN. And these companies are renowned for being progressive, being famous for having like open floor plans and things like that, and have just been growing really rapidly within the region. And we think this will fit the ambience of the building, and the style and the tenancy mix would be appropriate.
with that strategy, though, can you talk through your leasing assumptions in terms of rents, tenant allowance?
Yep. So that would be scenario 15, page 59. Yep. So in terms of tenant allowance, firstly, for these alternate tenants to come in, we're giving them a $50 TI per square foot and a rent of $16 per square foot, which is very much in market rates. We're still going to have in those assumptions. So because we have 2 years to get pre-commitments before this, that's why we have 40% occupancy in terms of the smaller divisions, 40% vacancy in the smaller divisions and 30% in the alternative tenants in 2021, because we've had 2 years to secure that. And because there's such strong macro factors behind this industry, we believe we can drop that down to market rates by 2022.
How much more capital is needed in that scenario?
In that scenario. So if you look at the previous, growth rates is not yet. So I don't think there's a slide on this one, but in that event, what we're really going, the main advantage we have is that we're not having to rebuild the building. We're just adding in subdivisions into our base case. So
Yeah, so basically with subdivisions, your costs are going to be very, very minimal. So you need to add some glass doors, you have to separate the HVAC, you potentially have to, pay a little bit extra with the corridors to comply with fire safety regulations, but you're not really seeing anything more than, maybe $10 a square foot that you need to put into the building. So $10 a square foot, 900,000 square feet, it does cost a little bit more, but at the same time, it still delivers a 15.4% IRR.
And how do you deal with the loss factor now that you have a multi-tenant building?
Sorry?
How do you deal with the loss factor now that you have a multi-tenant building?
yeah, so in that case, we expect to exit at a lower IRR, a higher cap rate compared to if we had, for example, leasing scenario A, where we could secure USB to lease the whole building up.
Did you actually assume that your net leasable or your gross leasable building has shrunk?
Yeah.
Yes, so basically with subdivision, we assume that with such a big floor plate, generally you're losing about 15 to 20%. But what happens is with leasing, generally we do make up for it in the rent price. And that's because with smaller tenants, they don't care as much about the rent per square foot because they're not 600,000 square feet. They're looking at it in absolute rent terms. So, I'm paying $100,000 a year for rent. I'm fine with that. I'm getting good space.
So why do you think the seller's incentivized to enter into a no-shop, no-talk negotiation with you?
So with the no shop, no talk clause, they do need to sell. There's a lack of competitive bidders. So if you go back to that slide, it is a secondary asset. And from the case information, it's anecdotal, but Kirby could call 50 people, send his underwriting model to 5, and he wouldn't find a buyer because it's a super, super expensive asset in a secondary market, and there's just not that much demand for those assets at the moment, especially things with such prohibitive lease terms. So basically what we're assuming is that, we do possess enough leverage to acquire the options for a nominal amount. And if you wanted to, we could, the way we'd value the option almost is if, you could get a discount from $167 million, that's however much you would be willing to pay for the option in order to reach your minimum required returns of 15% to secure the partner.
If it's such a tough asset to sell, why do you think you only went to one equity provider?
No, so we didn't go to one. We decided to, look at one in particular.
Square Mile Capital was the most ideal we found. We went through a range of different private equity funds to consider the different options we had, but because Square Mile had been interested in providing option 3 debt financing for the deal, it's very likely that they would have already done the due diligence on us, as well as what we required from them was a quick turnaround, being able to allocate the capital quickly so we can make the bid. But there have been a number of other options which we have considered with experience in the market, especially secondary markets, and with the capital available to provide to us.
And did you discuss economics with Square Mile, governance, fees and everything?
Yes. So we introduced a promote structure in terms of fees. So how it's going to work is that up to 15%, which is the benchmark that we estimate on a project like this, which is, again, a value-add project but not opportunistic. So up to 15%, our returns would be in line with our equity contribution, which is 10% and 90% to them. However, if we can get returns above 15% and from the 15 to 40% benchmark, we then are entitled to 20% of all returns over that. And then the benchmarks progressively increase and our returns increase over time if we can exceed that further.
Are you going to speak to the tenant during the contract period? Are you going to be allowed to do that? Will the seller let you do that?
Yeah, so in our scenario, we do attempt to acquire rights with the tenant to negotiate exclusively.
And if they say, I'm not in the mood to negotiate now, buy the building or whatever, but what do you do then?
So what we found is that we don't have to speak to the tenant first in order to acquire the asset. So even in our worst case scenario, when they renew in 2018, we're still able to justify the returns which allows us to secure an equity capital partner. So it really doesn't matter. I think it's more there for our protection in case we decide to get.
And what are the assumptions if they leave the building? How'd you get to your 15%? How long did it take to lease up, your TIs, your downtime, et cetera?
I think we went through this previously.
So we'll go through it.
Yeah. So we're basing on so because we get the notice in 2018, we have 2 years to secure pre-commitments before this. We're going to be targeting mid-sized tech companies. As such, we can expect to get 40% vacancy in 2021 in terms of smaller tech companies, and 30% vacancy in terms of the medium-term tech companies. That's in 2021. And by 2022, we should have now completed a 4-year lease-up period, and that would allow us to get back to market rates.
And why do you think this building's going to attract tech companies? Don't they want to go to converted warehouses, cooler environments, the old tower where you wear beautiful suits and ties, which all look quite similar to me. Last time I got one of you guys at home, and they don't want to work where Daddy works. So why are they going to go into an old bank building?
Well, so we've basically identified that a lot of the co-working spaces and the entrepreneurial spaces around Minneapolis are new assets. So for Industrious, they own 20,000 square feet. They're in Class A office buildings. Floor 23. They're not in warehouses or industrial properties.
Well,
Secondly,
they're converted into large floor plate, creative, high ceiling, collaborative environments. It's actually hard to do in a vertical high rise. I mean, you can gut the floor, but if you have columns, it makes it more difficult. So is there market evidence that these sort of tenants are going to high rises?
Yeah, there is. So we looked at a number of case studies, and so we started with some of the ones you can see on the screen here. So JAMF, Site Improve, Horizontal Integration. So these were, again, sort of the same story of sort of startup companies within Minneapolis, maybe starting in, say, 2002 and growing from there. So looking at this one, for instance, they doubled the size of their headquarters to a 52,000 square foot A-grade office space, moving into the Minneapolis CBD. And similarly across these two examples as well, we have substantial growth in employee headcount, which is leading them to relocate to larger offices, which was in 2015. And furthermore, with horizontal integration as well. Again, the same story of these tech companies growing their headcounts exponentially and having to upgrade to A-grade.
Are these companies making money? I know they're growing, but are they making money?
I presume so, yeah.
Oh, well, they're not at a stage where we can find out their returns just yet.
So, your downside is that the current tenant leaves, and within 4 years you release the space, 100% of the space.
Yes, that's correct.
What about a downside where you can't do that? Because now you're talking about 900,000 square feet of space. Sometimes entire floors stay vacant for quite a long time. So, where's a real downside? So the downside of leasing up to 100%, pretty good.
Well, it's not leased up to 100%, it's leased up to market rates. So in that case.
I guess if we can go to sensitivities, page 76. So I guess what we can look at, exit cap rates, and while they don't go so high, changes in vacancies will probably result in exiting at a much lower cap rate.
Cap rates don't matter other than net operating income. You can't get the net operating income without the occupancy that we're talking about.
Yeah.
Well,
What was the net absorption of all space in Minneapolis?
So if you go back to the main slide, I think go slide 10, go back. Yep, so there it is. It's in the bottom here. This 2016 is year to date, and the reason why it's so low is because Wells Fargo recently relocated an entire building. So they moved to a much larger office, 1.1 million square feet. So we thought that was anomalous as such, and we saw that A-grade office vacancies were on the downtrend.
On the downtrend, so you've got 2011 to 2016, there's not that much of a downturn during a time when the national market has improved much more than that. Have you compared your market research, your Minneapolis stats to national stats to really understand? You're calling it a high growth market, and I just want to see some evidence of that.
Yeah, so we did. Go to the appendix. Then macro analysis. So we looked at some of the growth characteristics of sort of the microeconomy of Minneapolis and compared it to, say, the US. And we found that there's a higher percentage of people that have university education, there's a higher median income, there's a high percentage of people with tech workers, so I think it's 4.2% of the total Minneapolis population is working in tech compared to 2.9% within the US. And in addition to like a number of other sort of microeconomic trends, Minneapolis is performing very favorably.
Go back to 7 for a second, the net absorption.
Back.
Yeah, there. So for the last 5 years, the whole market has absorbed, what, on average, about 750,000 square feet a year?
That's correct, yep.
And what's the size of the total market?
I think it would be 33 million in terms of available stock for office.
So think about what you're thinking you're going to do. You're going to absorb 900,000 square feet or somewhere in that range over a 4-year period. You're going to get that much market share.
So what we've accounted for, to mitigate that kind of risk is that we're engaging in two different leasing managers, and we've calculated we have significant leasing commissions. So leasing commissions, I think, are based about 15 to 20% of an average of the next 5 years' rent that the tenant will be paying.
Well, certainly incentivize the brokers, but you got to incentivize your
And
Yeah,
looking
well,
at some other tenants as well. So for example, co-working space operating in the Minneapolis region right now is running at 100% occupancy. So they currently don't have desks. So we think there's definitely going to be demand there. And the other issue we can do, if the event that we somehow manage to have a completely vacant building, is we can also change that proportion of compared to medium term, small term, and co-working space, and see which of these different areas and which target size is doing the best for that level of demand.
I'm sorry, I have a more basic question. Where would they go for 900,000 feet? Are they going to go to 10 different buildings? And is that, I mean, maybe this is part of your thinking, is that there is no option, so they can't vacate the
So that's why our base case scenario is with leasing scenario B, where they renew for 755,000. So the reason we considered the worst case is because an equity
Do they
capital.
have options outside to move in, or is it just...
The only way feasibly that it could occur would be if someone like Wells Fargo went and bought them and then moved them all to San Francisco. But seeing as they are the 5th largest bank in the US, we feel that almost anyone would have a competitive problem with that.
Yeah, within the Minneapolis market itself, there isn't enough combined space to house 900,000 square foot.
Can't they do a build-to-suit with somebody?
There's no new supply coming up in the next 5 years. So as in, that could suit them in that, what?
Is there land you could build upon?
In the downtown area? Not that I'm aware of.
So, well, one other thing we considered when deciding that they're not moving is that they're a very large public company. They're doing very well for themselves. Why would they move? Risk the downtime. Risk having all this downtime and leave a building that was built to suit them in the first place in 2000. It didn't make much sense, and it would cost a lot of money. And they could. It's a possibility, but it's very, very low.
Well, what do you do if they say, you know what, I can't make a 10, 15, 20-year plan at this point in my life? I'd like to extend for 2 years.
They don't have that
What
option.
do you do then?
They don't have that option.
Well, they got the option of leverage because they're a gorilla tenant.
Yeah.
And the leverage of that tenant in that market is probably as good as it gets. So you're the owner, you just bought this prize, what do? You say, no, that doesn't work. And
Well, in that case, we would have to come to a decision with them and kind of go to see what they need and why they're doing that decision. So, for example, currently it shows that they're doing very well in terms of general economic performance, and the main consideration for them is just pure downsizing. So putting the number of employees into a smaller amount of square feet, and therefore that's why we think the most likely scenario would definitely be just downsizing in terms of going from, let's say, 100% occupancy to 80% occupancy or 50% occupancy. We don't really see that as a tenable option. And so if we can guarantee them, for example, there are other concerns why they're not doing currently, like exclusion rights, we feel that they will be able to come to an agreement with us.
I'm sorry, what was your scenario if they stay, if they opt to exercise their option?
So renew the whole building?
Yeah,
So then in that case, this is, so you'll, this is 66.
I mean, that would be your base case.
Oh yeah, so that's for example using the DCF, but in terms of what we would do in that case, we would exit early. Mainly based on the fact, so we've already acquired a PE partner who wants 15% returns, and if in that case we don't think that they're going to secure early, the longer we hold the building, the worse it's going to be for us in terms of our returns. As soon as they choose to accept that renewal, then our cap rates will decline considerably, because currently the reason we can enter at an 8.4% cap rate is because of the fact they only have 3 years left on their lease. If they can renew for longer, we will exit earlier, which is also one of the reasons why we picked debt option 4, because it allows us to prepay the loan and exit that quite quickly.
And I understand that you think they don't have the options, but it doesn't seem like you're giving them many carrots, right? So by them releasing early and allowing you to exit later, you're actually boxing them out of their participation. You're also providing them with tenant allowance, right? But it's at an increase in rent. So really, they're really not gaining anything.
Well, we're not really.
Carrots for them.
So we're not really boxing them out of their participation, because once they renew their lease in 2018, or even if they renew it in 2016 for an extra 15 years, the weighted average lease expiry rises considerably. The risk of the asset decreases, and that means when they in 2020, whether we sell the asset or not, they get participation. So the value of the asset then, having been de-risked, will be quite significant. So they still, they will still be participating.
They lock in.
Okay, yeah, so even if we don't sell the asset, they get.
Yeah, they would get it at 2019 in this case.
Okay, that's the final question. I'm sorry, we have to keep the 20 minutes limit. So the first team, once again, is Midas Capital. So judges, please make a note of that. Thank you very much.
Thank you.